Thursday, August 17th, 2023, Maneco 64, home of alternative economics and contrarian views. We're going to look at the bond markets today. They're showing signs of trouble. We've seen China selling a lot of treasuries in the last 12 months. And actually, they're buying a lot of gold. And it's not just impacting the U.S. Treasury market, it's impacting also the gilt market in the UK and all other Western markets. And I'm going to talk about what that means for not just the markets, financial markets, but for the economy and for consumers and for governments, of course. Before I do, though, I like to cover a little bit or talk a little bit about what's happening in Argentina. I did a video about the candidate Javier Milei. He won the primaries for the presidential election, which is going to be in October. He surprised everyone. And you will see a lot of coverage in the mainstream media that he's crazy, but that he's a radical right-wing economist, that he wants to abolish the central bank, which is a good thing in my book, of course. But there's an old saying about first they think I'm crazy, then they listen to me, and then they realize I'm right. But what I'm going to do is I'm going to recommend one of his interviews he did with a program in Argentina. I don't know if it's on TV or anything, but it's called the Beauty and the Beast program. So he's been interviewed by these two people, a man and a woman, and he put this in on his YouTube channel, Javier Milei. He has his own YouTube channel, and it is in Spanish. Unfortunately, I do understand Spanish, not 100%, but I get the gist of it because it's very similar to my mother tongue, which is Portuguese from Brazil. And if you understand Spanish, I highly recommend you listen to this because you really get it from the horse's mouth, because we're hearing a lot of things about this guy that I think are not 100% correct. They say that he wants to dollarize, but I think he wants to go even further. I put a link to an article on the Mises.org website where they talk about him in my previous video, and I'm going to put it up in the cards, which says that he's a Rothbard disciple. He started reading everything about Rothbard, everything that Rothbard wrote back in 2014, and then he started reading von Mises. So he is an Austrian school proponent. The interesting thing in this interview is he goes over money, and he actually uses the regression theory analysis. He goes back in time and explains how money came about through barter, and then that money became the most marketable commodity. So he's definitely read this book. And the other thing that is interesting, you've seen in the last few days that the Argentine government, they devalued the official rate, and the official rate is the bank rate for the peso against the dollar. It's almost like the official rate for silver that we get, the COMEX LBMA rates, right, that are completely manipulated. The black market rate, of course, in these countries, and I'm familiar with that because in Brazil we used to have that, is a lot higher. And yes, inflation is going to kick off, and you could even have hyperinflation. But as Rafi Faber noted, because Rafi has read Rothbard a lot, probably more than I have, Rothbard says that hyperinflation is a way to wipe out the elites, wipe out the central bank, and start from new. So you're probably going to hear a lot of negative things about what's happening in Argentina, but I think they could be on the cusp of turning things around. It's not going to be overnight. He even talks about the fact that it could take 35 years to get things right. So I think he's a really interesting character. And for those of you who haven't read this book, What Has Government Done to Our Money? I highly recommend you do. And the other thing he talks about is that he wants to abolish legal tender laws, which people are equating with dollarization. It might be for a while, but as we're seeing now, and what do I mean by that? Well, they might want to use dollars if the peso is no more, but they could probably start using anything they want. He mentions gold and silver a lot of times. I didn't hear him mention Bitcoin, and some people have said he's a Bitcoin proponent. No, he's a money proponent, and he says people should be able to choose what they use. So with that, let's go back to the dollar, to treasuries, because things are getting, they're coming to a point where we could have a crisis. And I spoke about that last year when gilt yields were rising here in the UK in the summer, around July, August, and I said we could have a crisis kickoff in the autumn or in the fall, in September, October, because that's how it usually happens. And if you look at the stock market, in the last month, for example, the NASDAQ is down 6%, the S&P is down 3%, and the Dow is down 0.5%. So, yeah, the markets are feeling, stock markets are feeling the pressure, not just the bond market. So how does it affect you, consumers? Well, you're a consumer, the government, and the markets. Well, you can see what it's doing to the stock market, to the corporate bond market as well. That's not helping because treasuries are at the base of things. What else? Mortgage rates I've seen in the US, they're at the highest levels in many decades. They're above 7%, the 30-year mortgage. And here in the UK as well, it's not going to help. I've seen, as I said yesterday, I think that some mortgage providers are going to lower their rates, but I think they're going to reverse that very soon because we're going to look at rates today. And governments as well, especially the US, after the debt ceiling impasse, they basically suspended the debt ceiling for, I think, 18 months. And the deficit spending and the debt have mushroomed. And of course, old debt is not paid down. It's just rolled over. So the higher rates go, the higher interest payments are going to become in the US. We see that it's approaching $1 trillion, and it's not going to get better. And the same thing goes for the UK. That's going to really hurt things. The public sector is going to continue to crowd out the private sector. It's going to crowd out savings and investments. And it's not good. And of course, the yield curve is pointing to trouble ahead in terms of the economy. So how is China related to this, in my opinion? Well, if you look at the major foreign holders of Treasury securities, China is number 2, mainland China. Japan, of course, is number 1. But since June last year, Treasury holdings by China have gone down from 939.2 billion to 835.4 billion. This is the latest data here for June of this year. So that's down 11%. So why is China selling treasuries? I think there's a lot of reasons. One of them is the geopolitical reason. They've seen what the U.S. and its allies have done to Russian foreign holdings, and they're concerned. So I think they will not sell all their treasuries because they need to keep some money in the bank, so to speak, because they do a lot of business with the U.S. So there will be a point where they'll probably slow down. But the other one is, I think that China sees that the U.S. Treasury is gone crazy and is spending money like a drunken sailor. It's adding on to the debt. And it's concerned because yields are also spiking, continues to go up, and the value of their bonds are going down. So I think that's the other reason. It's kind of like they're on the Titanic and they're in the presidential suite, or the diplomatic wing of the Titanic, and they're trying to prepare some lifeboats just in case. While everyone else is like has no clue what's going on. Of course, the people that are running the Titanic, the U.S. System, they're telling the people, the general public, the people in the second class, stay on the Titanic, go enjoy yourself. And there's look, gold and silver going down, there's no problem, right? They manipulate things. So I think that's what's going on. So what about in terms of gold? What has China done? Well, this is a pretty recent article, August 7th, 2023, and it's from Bloomberg. China's central bank adds more gold for a ninth straight month. And it's interesting that they've sold 11% in the last 12 months of their treasuries, and they've added about just under 10% to their gold reserves. So it says here, China raised its gold reserves for a ninth straight month in July as central bank purchases continue to underpin prices of the precious metal. A bullion held by the People's Bank of China rose by 740,000 troy ounces, the central bank said on Monday. That's equivalent to about 23 tons. Total stockpiles now sit at 2,137 tons, with around 188 tons added in a run of purchases that began in November. So there you go. So you might be asking, and I saw a comment yesterday, how come the gold price is going down if central banks are buying the most gold in recorded history? And by that, I mean in the last 80 years or so. Well, it's because there's something called the foreign exchange market, which is highly leveraged and it's highly hypothecated. So gold and silver are traded as foreign exchange in London on the LBMA and also in New York. And they use COMEX as well, and the over-the-counter market. And the foreign exchange market is, you can put $1,000 down and control $10,000. So the big bullion banks and the central banks, they throw a lot of paper at gold and especially silver, and they keep things like manipulated or suppressed for a while. But eventually they will need to cover their shorts, paper shorts. It's all derivatives, and that's why they're able to keep the sentiment down in the precious metals. But it won't last forever because eventually people will twig onto it and start buying the real thing, and they will need to cover their shorts. It's a very frustrating game. I've been playing it for about 20 years. Playing it means that I've been stacking for 20 years, and I've gone through this many times. And the first time I bought gold, it was just over 200 pounds an ounce, or $320 an ounce. And eventually it does what it says on the tin. So that's what's going on. That's why you're seeing gold and silver not do much, in my opinion. So now to the bond market and what's going on. Well, the 10-year yield is reaching its highest level since October last year, as you can see here. And if we break the high, intraday high from that period last year, it was at just below 434. You could see a lot of trouble ahead. And what does that mean? Well, I could see the central banks actually having to maybe intervene. We could see banks get into trouble. We could see the derivatives market, which I've spoken about many times. We could see accidents in the derivatives. It's highly leveraged market. It's the notional amount of derivatives is in the quadrillions or 1,000 trillions. So if these yields get very volatile, start to spike, you could see accidents like the one we saw last year in the UK, with the LDI market. It could be anything that we might not even have heard of. And we saw that the Bank of England had to intervene last year and do not QE. We saw that the Fed had to intervene in March and reverse all the QT it had done up until then with more not QE. So I think an accident is possible. Am I saying it's going to happen today or tomorrow? No, but it's brewing, in my opinion. So, and that, of course, hurts the Treasury. Their interest payments are going to keep rising. And then you have a look at the UK gilt market. Well, we're seeing the 2-year now almost at 530. We had dipped down in the last month to below 5%. And I think people like in the government and the mortgage providers, the lenders, they were a bit relieved, but now it's all going back up. So it's not a good thing. We're up about 10 basis points in the 2-year, and we're falling also now the 30-year, which is approaching 5%. That's up 10 basis points this morning at 493. So we definitely need to keep an eye on this. And there's another market that I don't follow that much, bond market, and that's the Chinese government bond market. And I saw a tweet by a German journalist on Twitter. He has a big following, and said China's collapsing. Look at their 10-year yield; it's dropping to 258, the lowest since 2020. Well, the Chinese CPI year on year, the last one is minus 0.4. So if you add that to 2.5%, which is the 10-year yield, investors in China are actually getting a 3% real return, while in the US, with treasuries just above 4.2, the 10-year, and the CPI at 3.2, investors are only getting 1%. So, and the Chinese economy is still growing at 5%. So I'm not trying to defend China. I'm just trying to look at the numbers and the facts. Yes, there's talk that they're going to stop publishing youth unemployment in China, but and that might be true. But here in the West, they don't add the people that have given up looking for work in the unemployment data. They don't add people who are claiming benefits here in the UK. There's hundreds of thousands that really are unemployed but claiming it. So I'm just saying you need to keep an open mind and be objective. But one thing I noticed about the Chinese, government bond curve is that it's a normal upward sloping curve, which means that it's not inverted. And inverted yield curve, of course, eventually when it disinverts back to zero, if like from the 2s to 10s, it means there's a recession. There's always a recession once the curve inverts. It doesn't happen right away. So what this upward sloping Chinese government bond curve is telling me is that the economy is not really, it's not pointing to a recession there. So I think China will be okay. And it's interesting that all this with the US Treasury market and the UK gilt market, it's all heating up as we approach next week. And what's next week? Well, it's the BRICS Summit in South Africa on the 22nd. And a lot of people, of course, in the mainstream and even in the alternative have been poo-pooing this, that it doesn't mean anything. But of course, I think it's all speculation, what we think. And that's why we need to wait and see. But I think it could be very like an important event, not just for the BRICS and the de-dollarization move, but also for treasuries and Western bond markets, because the more they de-dollarize, the more they go off sterling or the euro, the more they use their own currencies, the less demand they'll have for our bonds. And that's what it's all about. And I think that's going to hurt us in terms of the inflation as well. Prices are going to keep rising because if there's less demand for our currencies are going to be worth less. And that's what higher prices are. It's the less your currency is worth, the less you're going to buy. And it looks like prices are rising, but it's the currency that's dropping. So there you go. With that, let's quickly look at the markets. We won't look at the bond markets today because we've looked at it already. So it's 8:38 a.m. London time. We've got spot gold at 18.96. It's up $5. The high's been 98, the low 89.50. Silver is up 1% at 22.65. It's up 24 cents. The Dow futures up 80, Nasdaq 100 futures up 21, S&P's up 6. To the currencies, sterling is unchanged, 127.35. Euro is unchanged, 108.80. The dollar continues to rise versus the yen. We're at 146. It's unchanged, but the high's been 146.57. So what about the yuan? Well, yuan is unchanged at 733.57. To the other currencies now, we've got the Aussie dollar down 0.5%, 63.95. We've got the dollar unchanged versus the Canadian dollar, 135.23. And the Kiwi dollar is down 0.2 at 59.25. WTI crude is up 0.5% at 79.50. Brent is up 0.5% at 83.60. Platinum is up $5, trading around 890. And high grade copper is up 0.5% at 370.50. So with that, I'm going to wish you all a very good day. Take care. Bye.